But welcome to the weekly Saturday knowledge sharing webinar organized by Mehta and Mehta. Thanks a lot for all of your time. Today's topic is further public offer. As friends, you know that we are carrying the series of ICD, and in that, today's topic is further public offer and want to discuss the topic. We have taken this, and today's our panelist is Mr. Brijesh Parekh, founder of Unistone Capital Private Limited. Welcome, Mr. Brijesh. Thanks a lot for your time.
Yeah,
To
madam. Thank you so much. Yeah.
to formally introduce our panelist, Mr. Brijesh Parekh is the founder of Unistone Capital and veteran investment banker. He has more than 2 decades of experience in equity capital market, proprietary fund management, international derivative markets, and investment banking. During his stint, Mr. Bridges has worked on various deals, including takeovers, IPO, mainboard, and SME, qualified institutional placement, merger amalgamation, business valuation advisory assignments, SEBI and stock exchange compliances, and international liaison with foreign banks and regulators across London, Singapore, and Mauritius. At Unistone, his deep understanding of the capital market helps our clients in various fundraising transactions and pre-IPO placement through his access to proprietary funds, HNIs, and institutional investors. Kinjal is Chartered Accountant and Company Secretary. She previously gained experience in EY Assurance, auditing prominent private sector banks, and contributed to M&A transaction with EY Strategy and Transaction Advisory team. She worked with Black Soil Capital, a venture debt fund, underwriting investments in growth companies currently. She serves as a senior associate in Mehta and Mehta's IPO team. Our today's moderator, as usual, our Mr. Bala is there. He don't need an introduction. Mr. Sudhakar is joining us, but he is joining a little late. With this introduction, I'll request we thank all our panelists for today's webinar for joining us on our knowledge sharing journey on behalf of entire team of Mehta and Mehta. With this, I'll request our panelists to say a few words on the topic, Mr. Bridges, and then after that, Mr. Bala, few words, and then Kinjal, you start the presentation. Over to Mr. Bridges.
Yeah, good morning, everyone. And thank you so much for joining on this weekend. And thank you so much, Mehta and Mehta, for providing this opportunity for the knowledge sharing. So I have almost 35 years of experience in the capital market. I started investing since my F5 BCom during my graduation time of Narsi Monji. And we have seen so many ups and downs globally as well as domestically. But we feel that in any economy, equity raising is the main pillar, and that's why I joined investment banking. And after working with various organizations, I started this venture in 2020. And by that time, we have raised more than $1 billion through around 45 transactions. SME, mainboard, QIP, and rights issue. Current scenario, we have seen the highest fundraising in last 5 years. And generally, we have a very strong nexus and connections with reputed chartered accountants and company secretaries like Mehta and Mehta, and they are the base. So generally, we approach them because every practicing chartered accountant, CAs, and advisor, they have at least 9 to 10 good clients. And from traditional practice, we generally guided them that please approach your clients through for the fundraising, which will help them for the working capital as well as the new expansion. In last 6 years, we have seen highest ever capex done by the SMEs to large organization, and that's why India now from around 7 to 8 position we shifted to a fourth position, which is remarkable. And Modi ji's vision to make this company multi-trillion economy, I think so. Capital raising, fundraising is the key. Now we have option either through debt or equity. So that is the different topic of the discussion. But I think so. Equity is the key, and we have seen in past group like Reliance, Tata, Birla, Adani's, they have grown at this level. We have seen the highest ever market capitalization by this large organization Adani, Ambani, they moved, I think so, among top 10 entities globally. So always they have raised equity, then debt. So it's a combination of debt and equity through various. I think so. Today we are discussing on further. OFS, I believe. So, Mehta and Mehta will guide further on the process and the procedure for the same. Yeah, thank you so much.
Thank you, Mr. Bridges, for your inputs.
Good
Over to
morning
Mr. Bala.
good morning to all of you. I have a great pleasure in welcoming you all to our knowledge sharing. As Dipti puts it initially, yes, we are conducting the series of main board listing initially. So we are taking ICDR regulation. Now, although there have been various methodology of fundraising is there, FPO, that is follow on public offer, is one of the method which is actually there, but to some or other it is not very popular. Many of you would not have seen many of the FPOs actually coming out in the market. But being a old timer, I have seen actually way back in 2010 and early. This method was very popular way of fundraising among the public sector undertaking. I categorically remember way back around 2010 or something, Metal and Mineral Development Corporation and again Power Thermal Sector, NTPC. They two people, they actually gone for the FPO those days, which was very become successful. After that, I have not seen much of the things. And again, in the recent past also, I've been actually keeping a track. When I've been keeping a track, I have actually seen way back in 2025, that is the recent one. There was a company called Adari Enterprises. They wanted to round 20,000 crores of the FPO actually. They got ahead and other thing and all. Ultimately, I don't know what was the real problem, but ultimately the FPO got actually cancelled. They could not raise the money. But at the same time, around the same year, there was a Texala and Moderna. They were successful in raising a FPO. This was the recent issue in 2025. If you go to the history, you can actually see there are a couple of people, but very few people were actually there. That was the thing. I don't know whether you are all aware. Yes Bank, which is actually on the discussion nowadays, that was also one of the company which actually raised the FPO issue. Actually, beside that, that is, I think, way back about 5-6 years back, I remember. That was the really speaking, FPO is there. It is one of the methodology, but hardly it is being utilized. But nevertheless, as every company secretary's dream to handle at least the public issue, either it is IPO mainly, that is the main dream, because every company secretary wanted to work with the listed company. They wanted to handle the IPO. That is a big dream for everybody. Some are successful, some are not. Much will depend upon. But nevertheless, since it is there in the ICTR regulation, this is one of the things which is available, the avenue, that we can actually have a look at it. That is the whole purpose of taking up this particular session. I think Kinjal is actually going to discuss the various nitty-gritties on this issue. And we have the panelists who is very expert for the last over 3 decades of the experience, who has been associated the merchant banking division, and he has been having a lot of practical experience. We can actually hear from him the practicability when we actually go along that. With that, I think I'll ask Kinjal to go ahead and make the presentation to the audience.
Thank you, Mr. Bala. Yeah, Kinjal.
Hello, everyone. Yeah. Hi. So, good morning. As we know, today's presentation is a continuation of our ICDI screen.
Yeah, it is visible. You have to put it in the presentation mode.
Right. I hope you guys can see my screen.
Yeah, very much. Very much visible.
So today's session, we are going to cover concept of regulatory architecture under which it functions, eligibility to come up with an FPO, then the requirements when under the FPO, which includes promoter contribution, lock-in requirements, and is put out, fast track option under FPO, the allotment process, FPO process, and the role of us as professionals in this particular process. So FPO is also referred to as further public issue, is an offer of specified security by a listed. It also includes an offer for sale to the public by an existing holder of such securities in a listed issuer. So this comes under. It is different from IPO in the sense that while IPO is the first offer of securities to the becoming listed through an IPO. Whereas FPO is once it is listed, the company comes out with subsequent public offer. So in an IPO, since it's a first ever offer to public, there is no existing market price
Kinjal, I don't know. I am getting some sort of the voice
reference
break in
for this
between.
particular company.
Kinjal, I don't know whether I am only getting it or others also.
No, there
some
is a problem. There is a problem. I told IT department to check.
Okay,
Just,
okay.
Can you hear me? So just try and fix this.
just participant 2 minutes. We are just checking if any technical hitch is there. Just 2 minutes, please.
Yeah, that
Kinjal.
voice is being checked and it will be set right.
So, sir, by the time I can share some
Yeah,
of
Yeah,
please,
sure. Please go ahead.
Yeah. So, friends, since beginning, I have the highest respect for the company secretaries and chartered accountants. As I told earlier, that all these practicing chartered accountants and CAs and advisor, when you start your practice, so you have in your mind about your nature of the client. So apart from traditional practice, please approach them for the fundraising and which will help them to take to their organization to the next level. See, without fundraising, so daily we meet at least 5 to 6 promoters, especially in 2 and 3 tier cities. So still they are not well versed with the process, and they are so much worried about the compliance part, etc., etc. But anyway, now our organizations are so complied. So I don't think so that fundraising should be the concern. So please guide them. And now we have various options of SME, main board IPO, FPOs, rights issue, preference shares. And generally, when you raise the particular amount of money, you can at least raise 2 times of the debt. And when these organizations are not doing capex, so someone else are doing. And fortunately, with the Atmanirbhar and so many initiative by the government, now India is getting after China, I think so. We are emerging and we bypass entire Euro region. So we are emerging and we have the finest EMS companies like Dixon Technology, and they are manufacturing Apple and Samsung globally, and we are exporting also. So we have never seen this kind of momentum. So whether you are into manufacturing industry or service industry, equity is the key, and you can also raise the debt. But I feel that by diluting some percentage, see, business overall, now we have seen so much volatility globally, lots of global volatility in foreign exchange, all the commodity price, logistic, etc. So when you have raised the equity, you are not immediately answerable. So generally, when any of the investor or mutual fund or QIP invest, so they have long term horizon. And as we know that all these organizations and companies are on work on the perpetuality, and in debt you are immediately answerable. You have to shell out some of the cash flow for monthly interest and principal amount. So combination of equity portion and debt, I think so. You are all very mature, and since you have joined, so in the combination, you can take your organization and you to the next level. Yeah, Kinjal, if you can, so I can stop whenever you are ready.
Thank you, Brijesh. You added on right point, but at the same time, I also like to tell when you talk about the equity and the debt, there are two aspects of it. As the company secretaries are not only being a compliant professional, they are also strategic advisor to the board. Much will depend upon the business and the nature and the size of the company, small, medium, bigger, whatever it is. So we'll have to thoroughly study and we'll have to take a call whether debt will be better or equity will be better or combination will be better, because each of the methodology has got its own advantages and disadvantages. Because when it comes to the servicing of the equity, the servicing cost is very larger for the equity shareholder compared to the debt. But at the same time, in case of the debt, there is a commitment of the interest charges, which is committed, which has to be paid, irrespective of whether you make a profit or not. But whereas it comes to the equity, then your reward comes only when you make a profit. Reward is not required to be given when you are not making a profit. Various, all these aspects are there. But the only thing is, yes, as a strategic advisor, all our professionals, that is, let it be a chartered accountant or company secretary, they have to take a call and they have to weigh the pros and cons and accordingly, to advise. Again, the tax perspective, in case of the debt raising, then it is always tax deductible. But in case of the equity, it is actually, it is not tax deductible because it is actually distribution of the income after the tax is paid. So all these aspects also which play a major role while taking a strategic decision.
Yeah, sir. See, appreciate. See, in India, if you see that all these debt-free companies are getting very, very higher multiple. But if you tell me that combination of debt and equity is always the right choice, especially when your debt equity ratio is up to 0.75 or zero point 0.5, again depends upon how much capital intensive you are. So all these debt-free company now India has the uh, latest approach that are you a debt free company or if you are reducing your debt, so all these companies are getting higher multiple. So when you are getting higher multiple, again your equity dilution will be the lesser. Why all these multinational companies, see, globally Unilever, Nestle, Glaxo, all these companies are available at 25 times, 30 times max of the profit. In India, all these companies are available at 50 to 80 times. Siemens, ABB. Of course, we have far, far better prospect, and all this developed economy has limitation. So, of course, since we have all this mature strategic advisor, maybe some on the management team, so they are the best people ultimately, sir. Whenever you are doing business, so what's our main agenda? That we should be valued properly. So
Absolutely correct what you actually said. Again, you touched upon one more very important point, what you call dilutive and non-dilutive.
yeah,
So
sir.
when
So it's always. So I think so that you should take second session. I believe that is also very brainstorming. It needs lots of brainstorming. And of course, if you tell me that debt is always cheaper, but sir, see, as we have seen lots of uncertainties and business environment becomes so dynamic, then what I feel that as a safe side, equity, because you are not immediately answerable to your shareholder at least. And of course, see here agenda is anyway the promoters are deploying all this fundraising whether through debt or equity in business channel also. Like earlier we have seen lots of organization and promoters were vanishing, and nowadays in BJP tenure we have more stringent regulator and SEBI, BSC, NSE. So now these cases and NPAs are reducing. So of course we have better environment. And sir, fortunately, see, ultimately you belong to which segment, that is very, very important. Friends, please try to understand that traditionally textile or metals, they have never got real estate, never got proper valuation. So the bottom line and crux of the thing is that you belong to which segment. In 2020-21, we have seen the pharma industry, they all rewarded 6, 7, 8 times, and they raise fund at around 30, 40, 80 times of the profit, not a P ratio of net profit. And eventually that all the stock corrected. Now we are seeing capital goods, defense companies, they are getting valuation. So, sir, what I realize that if you are belong to particular segment, now, see, earlier Hindustan Lever, Astral, or Pidilite, all these consumer companies were available at 80 to 90 times. Now they have reduced to 45 to 70, 80 times. So when your segment multiples are higher, so at that time you should raise the equity. Then eventually everything will be melt down. In 21, 22, 23, traditionally all this Umber Enterprise, Dixon Technology, the B2B contract manufacturer for OEMs like Apple, Samsung, and maybe Carrier Aircon, AC, mobile, etc. So they are working. So these companies were available at 120, 130 times of the profit, which eventually reduced to 70, 80 times currently. So what I realized,
as Christian puts it, I also agree with him, really speaking. There are multiple things one has to take because what is the nature of the industry, what is the size of the industry, which segment they are serving, what are the need, whether it's the short-term capital, whether it's the long-term capital, whether it's the project capital. All those things which are actually there to go as rightly Bridges puts it, one has to sit with the management team, we'll have to understand, we'll have to do the thorough study and they can give a proper advice. That's what it is. As a thorough professional, we should do that. Yeah.
Yeah. So, sir, see, currently, if you see that we have seen massive rally in all these metal stocks, Vedanta, Tata Steel. So currently, metal is in the favor. So I believe that you belong to whichever currently, if that segment is favor, ultimately you need lots of follow up buying and lots of traction from different HNIs, ultra HNIs, institution investor, defense, aerospace. So again, that is your call that in this market the sentiment whether you belong to right segment for the fundraising or not. I think so. Kinjal is ready now.
Kinjal, you are ready?
Yes, yes.
Yeah, you can
I'm
go
so
ahead.
sorry about this. Yeah.
No problem. It all happens. It's all beyond our control. Technology we can never believe because something goes wrong.
Just one.
You can at least have a little satisfaction looking at the number now.
Yes.
Yeah, 132. People interest is there. As I said, some people, they wanted to skip the introductory portion. They wanted to join in the main course. That is the whole issue.
Right.
Right. So, like I mentioned, the difference between IPO and FPO, IPO, the company is getting listed for the first time, and whereas in FPO, the company is already listed, coming up with a additional issue of shares. And since IPO, the company is getting listed for the first time, there's no existing market price reference, and because of that, people don't know what this company is, the past history, etc. So there's higher regulatory scrutiny at this stage. Whereas for FPO, market price already exists. And company is already listed on the exchange, so people know about this company, and it is regulated under Chapter 5 of ICDR.
You're absolutely right, Kinjal, because FPO, we already done a lot of job on the case of the IPO. So naturally things are there. There is lesser amount of the compliance, lesser amount of the requirement which are actually there in case of the FPO. That is one thing. Second thing is when you say it is a subsequent offer to the public, that is true. Again, the question of, dilutive or non-dilutive comes into the picture. If you can have an option, either you can issue a fresh share. When you give the fresh share, then it becomes your dilutive. You create a more number of shareholders, etc. Get disposed. On the contrary, if major shareholder they wanted to actually dilute their holding, in such a cases, what happens is that is actually given. What you call it, offer for sale. That way of the thing which actually goes in the FPO. In which case it becomes a non-dilute.
Yes. So coming to types of FPOs, so there are three major types, three ways in which essentially an FPO is issued. One is you have like a fresh issue where a completely new shares are issued to the public, and because of this, share capital increases, and the proceeds raised from this sale of shares flows into the company, and existing shareholders percentage ownership gets diluted, and this is usually genuine capital raise for certain projects, debt repayment, working capital, etc. Then coming to the second one, which is offer for sale. This is non-dilutive in nature. Existing shareholders sell their shares to the public, and no new shares are created. So share capital doesn't increase as such a way. Proceeds from selling such shares go to the selling shareholders and not to the company. So there's no dilution of earnings per share, equity capital, etc. And this is usually used for government divestment, since government historically has used this method to raise funds, and promoter exits, trying to comply with minimum public shareholding requirement, etc. Coming to composite issue, which is a combination of different types of issue, offer for sale, fresh issue, rights issue, etc. Now, fresh issue component plus OFS component is possible under this issue. And the lock-in applies only to the FPO component, not the right issue if you're coming out with the right issue. And promoter contribution requirements also exist under this issue. And if there is say a right issue and an offer for sale FPO that is being issued, then both set of regulations will be applicable for the particular total issue that is being issued. So, like we have mentioned, there are this mechanism is less popular, and so historically there are less cases where companies have used this route to raise funds. But Yes Bank FPO in 2020 was one of the major ones that came out with an FPO, and it was a nearly failed financial institution where Yes Bank was suffering massive NPA at that point in time. There were a lot of governance failures. There was a near collapse, and RBI was just trying to scramble to get this company to survive. And so it came out with the Yes Bank reconstruction scheme, where various banks such as SBI, HDFC, ICICI, Axis, Kotak invested some 10,000 crore under this scheme. And it at this point in time, it used this route to raise funds from the public in order to stabilize the company. The company didn't have an identifiable promoter. So as we know from our IPO session, in the DRHP that comes out, the offer document for the issue of shares, we always have a promoter that is mentioned. But in these cases, in certain professionally managed companies, the promoters aren't available. So here there was no identifiable promoter. And so the promoter contribution requirement was not exempted over here. And it since it was a bank that was suffering heavy losses, it was trying to survive. It couldn't go through the normal route, which we will talk about later, which is track A eligibility standard route, where the company needs to have profits and net worth and other such financial requirements. They had to go through the book building method, where a lot of the section of the FPO is allocated to QIBs. And as we have seen consistently for even the IPO, where you have a book building method, a lot of it goes to allocated to QIB. Now this went through fast through despite fast track, which again we will cover later. Despite COVID, and QIBs got a major chunk of the FPO, and non-institutional investors also participated, employees also participated, retail also participated. And it was actually a success and was oversubscribed almost 3.5 times. And the capital raised under this issue helped the bank return to operational stability, and listed shares resumed normal trading post this particular reconstruction. So this was one of the few success cases that for funds raised under IPO that helped company kind of get back to operations and normalize operations in Indian history. Another one is Coal India. Now, like I mentioned, there are FPOs many a times used by governments for divestments, and Coal India and State Bank of India were one of these other two FPOs that have come out. One in 2015 and the other one in 2014. For Coal India, it was one of the largest FPOs by at that time, where government of India was trying to divest its stake. It was a combined offer of, sorry, it was 100% offer for sales, and no, so it was a pure divestment transaction that had occurred. and even retail investors participated, and the shares were listed at a discount of around 5%. So, as we know, since the shares of the company are already listed, what makes FPO kind of attractive for additional investments, additional public interest would be the discount that is provided under this issue. So this issue was actually provided at a discount of 5%, and government was trying to through this issue trying to comply with the minimum public shareholding requirement, and trying to raise the public shareholding in the company. Again, this was oversubscribed, so it was a successful issue, with participation from QIB, NIIs, retail segments. And again, like since it was an OFS, the issuer company, so Coal India, bears all the cost, compliance obligations, costs that comes with this particular issue. Coming to State Bank of India, again, this was, like I mentioned, a divestment transaction by the government. And sorry. Coal India was divestment transaction. State Bank of India, it issued fresh shares, and new equity shares were, and it was a book built issue, where Government of India was mentioned as the promoter of the organization, of the company, and this was to strengthen the capital for the company, and it was again fully subscribed, where retail investors also participated.
You're right, actually, Kinjal, in stating, this particular method has been very, very popular among the public sector undertaking, when actually government wanted to actually divest their funds and then offer to the public. That was the case, actually. As I mentioned to you, it was very popular. It was seen, I think Brijesh should be knowing it, since he is there for the last so many decades. Way back in the early 2000s, if you have seen, a lot of PSUs, they actually came out with this particular issue. That is what it has actually come out. One of the participants is just a sharing. I remember having pulled out of all the money from the S Bank in this particular March 20, just before PM announced the lockdown. That is what he is actually saying it. MPSC obligation is this minimum public shareholding capital norms. That is what another question.
Coming to the regulatory architecture, there are several laws that govern this FPO in general. The main one being the SEBI ICDR. But you have your SEBI Act also, that grants SEBI the authority to regulate. You have Companies Act sections 23, 39, 40, 42, 62, that deal with prospectus, allotment, listing, private placement, further issue of share capital, ROC filings, etc. You have SEBI LODR, since the company is already listed, they are required to follow SEBI LODR, that requires continuous disclosure obligations, and corporate governance standards, even material event disclosures related to FPO. In case of any foreign investments, any kind of FDI, FPI participation in the FPO, then you have FEMA kicking in. Foreign investors through FPI can subscribe to FPOs, subject to sectorial caps and pricing compliance. Anyway, coming to SEBI pitch regulations, FPO process is a undisclosed price sensitive information event, and the issuer must manage trading windows to ensure no insider trading happens during the price discovery process. You have other regulations such as Securities Contract Regulation Act, that deals with listing requirements such as minimum public shareholding, etc. You have so these regulations make up how FPOs are regulated in India. Now, coming to Chapter 5 of SEBI ICDR that regulates FPO, it is divided into 8 different sections that cover 8 different topics, being eligibility conditions, promoter contribution lock-in, appointment and filing, pricing provisions, green shoe options, which we will look into later, issue period and application, post-issue obligation, and fast-track FPO route. Coming to eligibility conditions. So, SEBI ICDR, it puts in place several requirements if a company wants to go for an FPO. Now, there are two ways in which a company does this. One is the standard way, which is track A, and the other is the book building way. Now, the standard route requires financial eligibility. Now, the issuer must meet all of these conditions, um, computed on consolidated basis, um, in order to go for an FPO through this route. So you have net tangible assets should be at least 3 crores in each of the preceding 3 full years, of which not more than 50% is held in monetary assets. Then average operating profit of at least 15 crores during the 3 most profitable years out of the immediately preceding 5 years. Then the company must have a net worth of at least 1 crore in each of the preceding 3 full years. It must also have the aggregate of the proposed issue size plus all previous issues in the same financial year must not exceed 5 times the pre-issue net worth. And in case of a name change, then the name change rule applies, where within the preceding 1 year, at least 50% of the revenue for the preceding 1 full year is earned under the new name. The second way, like I mentioned, is the book building method, with where 75% of the issue must be allocated to QIB. If the issuer does not meet the financial criteria that's required in the first method, then they can go for this book building method. Like I mentioned, in the case of Yes Bank, they had used this because they were suffering from heavy losses and financial difficulties at that point in time. So the issuer undertakes to allot, like I mentioned, at least 75% of the net offer to the public to qualified institutional buyers. If this minimum allotment requirement is not met, then the full subscription money is required to be refunded. Then it's a failed issue. And then there are certain, under regulation 103, there are certain scenarios where companies are totally not uh, made ineligible to go for this particular FPO. So these are these are entities. If they fall under this category under regulation 103, then they are categorically explicitly disallowed from going for FPO. Now, this is in the case of where the issuer or any of its promoters or promoter group or selling shareholders are debarred from accessing the capital markets by SEBI, or in case of any of the promoters or directors of the issuer is or the director of any other company that is where the promoter or director is a part of is debarred from accessing the capital market by SEBI. Another case is where the issuer or any of its promoters or directors is a willful defaulter as declared by any scheduled commercial bank or financial institution, or in case of any promoters or directors who is a fugitive economic offender as declared under the Fugitive Economic Offenders Act 2018. So in these cases, the company is explicitly not allowed to go for an FPO. Now, where an FPO includes an offer for sale by existing shareholders, then each selling shareholders must have held the shares for at least 1 year prior to the date of filing of DRHP for the FPO. So whoever is selling the shares the existing shareholders who want to sell their shares through an FPO must have held the shares for at least 1 year before the filing of DRHP for this particular FPO. In case of ESOP, they are eligible for without the 1 year holding of shares conditions, provided ESOPs have been issued at least 1 year prior to the date of filing of DRHP. Now, usually, pledged shares are not allowed for to be sold under the OFS route of an FPO, but there is an exception to that if such shares are pledged with any scheduled commercial bank or public financial institution where the loan has been used for the business of the issuer. Only then such pledged shares can be offered for under under the FPO route. Coming to promoters' contribution and lock-in requirements under ICDR for FPO. So for an FPO, the promoters must contribute to the extent of 20% of the proposed issue size or to the extent of 20% of the post-issue capital, whichever is lower. Whereas in the case of a composite issue, where you have FPO plus rights issue or OFS fresh issue, etc., the promoter contributes either 20% of the proposed issue size or 20% of the post issue capital that is relevant to the FPO portion of the issue, which means that such computation of 20% is only done for the FPO part of the issue and not the rights part if there is a composite issue of FPO and rights that the company is coming out with. Now, this minimum promoter contribution requirement has certain exemptions where it may not be enforced. The first one being where the issuer does not have identifiable promoters only. Like in the case of Yes Bank that we looked at earlier, where there was no one particular identifiable promoter. These are companies that are run professionally, and you have financial institutions such as SBI, HDFC, or LIC, or all these different kind of financial institutions who have hold significant stakes without being classified as promoters. And in the other case, where such minimum promoter contribution requirement is not required, is where the equity shares of the issuers are frequently traded on a stock exchange for a period of at least 3 years, and the issuer has complied with SEBI LODR regulation, where there is no non-compliance under LODR for the preceding 3 years, and the issuer has redressed at least 95% of the complaints received from investors. So these are, and all three conditions must be met. Only then the company can be exempt from the minimum contribution requirement, minimum promoter contribution requirement. Coming to the lock-in provision, now this is again a foundational investor protection mechanism where it ensures that promoters also have skin in the game post the FPO. Now, for minimum promoter contribution of 20%, the lock-in requirement is 3 years from the date of commencement of either commercial production of a plant machinery for which the funds have been raised, or the date of allotment in the public issue, whichever is later. Any kind of excess holding by promoter beyond the minimum promoter contribution, the lock-in requirement is 1 year. And any kind of non-promoter pre-issue shareholders, the lock-in is 1 year from the date of allotment. Now, under Regulation 119 of ICDR, locked-in securities held by promoters may be pledged with any scheduled commercial bank or public financial institution as collateral security for loan subject to conditions. Number one being, if the securities are locked as minimum promoter contribution, the loan must be for financing the objects of the issue, and the pledge must be created before or simultaneously with the allotment. So, in case of pledging, these are the conditions that must be met. In case of transfer of locked-in shares, so if such shares are must be transferred while they are locked in, then there is a requirement where if they are transferred among promoters or to new promoter or person in control, then the transferee inherits the lock-in obligations. So the lock-in period continues even after the transfer. Coming to the pricing mechanism of an FPO, so how is an FPO priced when it comes to raising funds? So, like I meant, like we had discussed in our IPO session, um, there was a book building process, there's a price discovery, etc., that happens. But this, in the FPO case, the scenario is relatively different because the shares are already traded on the stock exchange. There is already a price that is and value that the shares already hold. So, for a company coming out with an FPO, pricing mechanism regulations are a little different. So, coming to an issuer making an FPO may freely price its equity shares in consultation with its lead manager, subject to one constraint, that is, the issue price shall not be less than the face value of the equity shares, as required under Section 53 of Companies Act. Now, beyond this minimum, market forces and book building process essentially determine the price. In a book build FPO, the issuer may allocate up to 60%, like we saw, 60% of its offer to QIB portion, 60% of the QIB portion to its anchor investors. This is in line with our IPO, where in there also, whatever allocation was done to the QIB, 60% of that was done to anchor investors, which are large institutional investors with a minimum application requirement of 10 crores, and they are allocated shares one day before the issue opens, and they are required a 30-day lock-in from the date of allotment. Now, these anchor investors are important, like we had discussed in our IPO session also, that anchor investors are extremely important in an issue because they are the ones that aid with price discovery, and their participation essentially signals the institutional confidence in this particular issue, and hence kind of uh, provides an indication for the demand for this particular issue. Another way, which is, I mean, almost non-relevant, is in because it's not used frequently, is the fixed price issue, where a fixed price is determined by the issuer in consultation with its lead manager before the issue opens, and the price is disclosed in the prospectus filed with ROC, and all applicants apply at the same price. And it is not very common because without kind of book building, there may or may not be enough subscription, and just doesn't really help the company on an overall basis.
All said and
Coming-
done. All said and done, what happens is a price fix mechanism is more or less, remains in the paper only because hardly anybody uses it. Now everybody uses only the price band and the price discovery method only people are using. If you see whatever the issues which have come, capital raising program which has come in the last few years, everything is actually coming on the price band only. Hardly anybody uses this fixed price. Yes, you can use it, but the thing is, yes, that is not very attractive nowadays, as you rightly said. Yeah. Yes, go ahead.
SEBI permits differential pricing in an FPO, which is, the issuer may offer shares at different prices to different categories of investors. So, retail individual investors and employees may be offered shares at a discount of not more than 10% to the price at which shares are offered to other categories. So, again, there are, when a company is coming out, when a company wants to raise more funds from the market, there are a lot of other avenues available, such as QIP, rights issue, etc. But people many a times come for the FPO route, many a times to increase retail participation, increase retail eyes on the particular company. So here, if they want to make their issue more attractive to the retail investors, then through differential pricing, they can offer more discounts to the retail individual investors and employees to ensure there is retail participation in the company.
Richard, do you have any idea about this Adheri Enterprises IPO, FPO, which actually failed in the year 2025? You have any idea on this? Because when she raised this, the retail investors issue, etc., and other thing and all. Any idea on that? Why it has failed? Because it was such a big issue. It's not there.
I think there is an issue. We can go ahead. Later on, we can.
Then again, since if the FPO is a book built issue, then sorry. So unlike IPO, where price is anchored on financial valuations, FPO is slightly different. FPO has implicit market price reference since the shares are already listed. And so typically, FPOs are, like I mentioned, priced at a discount to the current market price at which the shares are trading currently to attract sufficient public interest. Now, the SEBI regulations do not mandate any specific discount to current market price for pricing this issue, but market practice and investor expectations kind of drive issuers to price the FPO attractively. Too large discounts create arbitrage risks where people subscribe and then they immediately sell in the secondary market, and too smaller discount results in undersubscription. So it is essential how this issue is priced, given the current market price of its shares that are already listed. Now, market price requires an attractive discount to ensure subscription. It is usually between 3 to 10% for large cap companies that come out with FPOs. Now, for a book built FPO, you have anchor investors that are institutional investors or QIBs who receive an allocation one day before the issue opens. Like I mentioned, their participation is important, it signals confidence, and they have a 30-day lock-in. Now, for the issue, for a book built FPO issue, you have 50% of the issue which is allocated to QIB, and the allotment is done on proportionate basis, where anchor investor is given 60% of the QIB allocation. Non-institutional investors and HNIs that can have an allocation of not less than 15% of the net offer, and allotment is done proportionately, lottery basis, where their subscription is above 10 lakhs. Retail individual investors have 30%, more than 35% of allotment of the net offer, and allocation is done on lottery basis, where minimum one lot is allotted to the retail investors, and their subscription is up to 2 lakh rupees. Employee can receive up to 5% of the post issue capital at a discount of up to 10%. on proportionate basis under the book-built FPO process. Now, there is a green shoe option. We might have heard of it. It is under section 133, which is essentially a price stabilization mechanism that ICDR provides for. In case where there is any kind of oversubscription. So in case there is an oversubscription of a particular FPO, then over allotment of up to 15% over and above the issue size can be issued under the green shoe option for the company. So in this case, the issuer must appoint a stabilizing agent, which is usually, your one of the lead managers, and they conduct market stabilization activities in the secondary market post listing. The stabilizing agent purchase shares from the open market at or below the issue price for up to 30 days post listing to prevent share prices from falling below the issue price. Now, proceeds from green shoe portion are retained in a separate escrow account, which is the green shoe option bank account and managed by the stabilizing agent. This was actually used in the NTPC FPO case in 2013, where they had this oversubscription issue. Now, for FPO also, there's offer document requirement, and every director who signs the offer document is personally liable under Section 35 of the Companies Act for misstatement, unless they can prove that they had reasonable grounds to believe that the statement was true and accurate. This has civil and criminal liability. So this is very important step for the issue. Now, Regulation 123 looks into filing procedure. So prior to making an FPO, the issuer must file 3 copies of the draft of a document with regional office of SEBI, along with fees as specified. And 1 copy is filed with the designated stock exchange where the listing is proposed. And the DRHP then must be made available on the website of the issuer, of the lead manager, stock exchanges. And a public announcement must be made within 2 days of filing of DRHP, disclosing the filing, inviting public to give comments to SEBI within 21 days of this public announcement. Now, Regulation 122 looks into disclosure requirement for the draft of a document. Now, the draft of a document must contain all material disclosures that are true and adequate to enable investors to take an informed investment decision. The lead manager is responsible for conducting due diligence and certifying the correctness of the disclosures. Key disclosures include risk factors, business description, industry overview, restated financials, objects of issue, capital structure, promoter and group related party transaction, litigation, government approved terms of issue, etc. Now, FPOs also have specific disclosure requirements beyond what is required in IPOs. So again, this was also required in IPOs, but FPOs have additional disclosure requirements. They are required to also disclose the details of utilization of funds raised through previous public or rights issue, to disclosing whether the funds were actually used in accordance with the stated objects of these previous issues. Any deviations from objects stated in previous offer document, details of complaints received and redressed by the issuer, and any kind of significant changes in accounting policy in the preceding 3 years. After such DRHP is filed, SEBI observations are received in response to this DRHP, and any pending these clarifications are made, any kind of queries raised by SEBI are resolved, and the RHP is filed with SEBI and ROC. which contains the price band, and it is open for open to public. Then you have the prospectus, which is the final document with issue price filed with ROC. And it's filed after the book building process. Sorry, abridged prospectus and it's mandatory to be given out to along with the application form for subscription to the prospective investors, and it's essentially a condensed version of the full prospectus. Coming to fast track FPO issue under Regulation 155, this is an option that is given to companies who want to go through an FPO. And so let's just look into who qualifies, what is fast track, etc. Now, fast track mechanism, it essentially eliminates the requirement for filing the draft of a document with SEBI and obtaining SEBI's observation, which is the most time-consuming, time-intensive step in the standard FPO process. For eligible employees under fast track, it allows capital raising in a matter of days rather than months. So the rationale for this is kind of straightforward. If a company has been listed for more than 3 years, it has high market capitalization, strong trading liquidity, and has complied with LODR requirements. The market already possesses extensive information about this issuer. So the mandatory SEBI review of DRHP serves a diminished purpose when compared to the IPO process where company is unknown to the market. So this fast track route essentially eliminates this SEBI process and pushes it forward to in a more time sensitive manner to ensure that the funds are raised quicker since the company is already known to the market. But
there is one question has come actually. Can you give a practical insight on how the views of the SEBI or ROC is different in case of the IPO and the FPO filing RHP? Point considered by SEBI and ROC for approving RHP filed for IPO and FPO. Brijesh is there? I think he's there, but somehow other I don't know.
I can.
Yes, sir. I'm here only. Yes,
yeah, could you take up this particular question this gentleman is asking? Can you give a practical insight as to how SEBI and ROC are different view in case of the IPO and FPO filing of the RHP? The point considered by SEBI and ROC in approving RHP filed in IPO and as well as FPO.
Sir, nowadays, as you know, since we are doing lots of ROC filing through Meta and Meta, now it's auto filing. Unless otherwise is there any litigation in ROC, it's now on auto approval basis, and there is no difference between IPO and FPO approval of RHP.
And SEBI also they have asked. The person has asked.
See, SEBI, as far as FPO is concerned, since it's already listed entity and disclosure requirement is less as discussed by Kinjal, so SEBI is more lenient toward FPO approval.
Yeah, generally what happens when we go to SEBI for IPO, then I think more of the scrutiny and from the governance point of view, compliance point of view, all such things are all actually looked into actually. But when it comes to the FPO, already the lot of complaints has already been done with. It is already known, many things have taken care of. There is a lesser amount of the things is there. That's what I believe.
Yeah, and
sorry.
Yeah, and there are few exemptions in disclosure. IPO vis-a-vis FPO.
In fact, I remember because I'm being a old timer. We have done it way back about 30 years back for the first time. When we went for the listing for the first time, they in detail they gone through the memorandum article and other things and all these things. One day we have been actually called there. When we have been called, they told that you will have a problem in disclosing your quarterly financial results because you have got one clause in the article regarding conducting the board meeting quorum. What is that it said is the quorum requirement has been specified, but it also said further, one of the nominated director from the parent company is necessarily required to be present for the purpose of the quorum, even though number of adequate number is there. If that particular member is not present, then quorum is not there. That was the clause is there. So they very strongly said, if this clause is there, if a particular meeting, if that person is not going to be available, how will you conduct the meeting? That means you will not be able to conduct the meeting. You will not be able to declare the results. That means it will be a non-compliance. So that time, we don't have much sophisticated digitalization, this, etc. Those days, the available mechanism was only either the telex operator or fax has actually come. So we have amended the article in such a way that that particular meeting, either the parent company or the concerned director, they can waive off the requirement of his presence for conducting the meeting. Such thing can be communicated either by telephone or telex or fax or whatever methodology, etc. and other things and all. Then we will be able to conduct. We'll have to amend that first. So to such a level of the scrutiny, they go into case of the IPO. But when you go to the FPO, I don't think, as you rightly said, yes. So compliances and other things, you are already taken care of a lot of things. That's what I also would think. Unless anything changed today. Yeah. Yes, Dipti.
Yeah. So to add practically that, see, both authorities are different. Their role is different. When the SEBI is there, their main role is the investor protection, the pricing. So they look at the pricing. What are the information given in the documents submitted are true. They have a good track record, all that, I need not mention for investor protection. So they look all the document in that angle. But as regards compliances, see, the company is already existing. What compliance it has complied with over the years, and what is the track record, and each and every shares issued are properly after compliance of the shares, Companies Act and other law has been issued. So that care is also taken. And when it goes to the ROC, it says that the company has up till now complied. The documents give all the true and fair, and also all the documents are properly given. What all certificates are required is given. All the originals are there. All that thing they check, and that if any compounding adjudication is required, that is carried out or not, the said application is filed or not. So they look at more at a compliance level. This is the difference between both the authority, as their role is different. Thank you.
Yes, Kinjal, go ahead.
So, in fast track FPO, even though SEBI observations are not included, all other provisions of ICDR regulations, which is your pricing, allotment, disclosures and offer document, ASBA, minimum subscription, post-issue obligations, they all apply in full. So if you're going for fast track, that doesn't mean that these other disclosure requirements, minimum subscription allotment, all these other requirements are also done away with. It's only the SEBI pre-clearance step that is eliminated under the fast track FPO. So they must not assume that if it's fast track, it means reduced compliance. Now, so for fast track, there are certain conditions that must be fulfilled for any company to go for the fast track FPO route. Number one being equity shares must be listed on stock exchange for at least 3 years. Entire promoter group holding is in dematerialized form. Market cap of public shareholding is at least 1,000 crore for the 6-month period, which is ending 1 month before the date of filing of offer document or reference date. Then the annualized trading turnover is at least 2% of the weighted average number of equity shares listed during the preceding 6 months. Delivery-based turnover, which is your annualized delivery-based trading turnover of equity shares, is at least 10% of the annualized trading turnover. Issuer has complied with the provisions of SEBI LODR regulations for immediately preceding 3 years. There's no lapses there. No show cause notices issued by SEBI pending against the issuer, promoters, whole-time directors, but does not excludes adjudicating proceedings. And the issuer must have redressed at least 95% of investor complaints. And there should be no settlement orders or directions pending under SEBI against the issuer, promoters, or whole-time directors, as required to be able to go for this fast-track FPO route. Now we'll just quickly run through the FPO process, how it goes about. So starting with board approval, the board of directors are required to pass resolution approving the FPO. Typically, this board resolution covers type of issue, which if it is fresh issue, OFS, composite, um, the proposed issue size and its objects, pricing methodology used, appointment of lead managers, intermediaries, constitution of IPO FPO committee for operational decisions when it comes to the issue. And where articles of associations require specific board authority for public issue to ensure compliance with Companies Act. Then you have the shareholder approval, which is required for. So, a fresh issue of shares requires authorization through a special resolution under Section 62(1)(c) of Companies Act for issue to public through prospectus, read with Section 23. Additionally, if an employee stock option plan is involved, separate shareholder approval is required. For offer for sale, the selling shareholders do not require corporate approval since they are selling their own shares. But the board of the issuer company must nonetheless endorse this FPO. So even though in the case of an offer for sale, selling shareholders is selling their own shares, but that particular issue must be endorsed by the board of the company. Then you have the due diligence, which is done by lead managers. The appointed book running lead managers, BRLMs, conduct comprehensive legal, financial, and business due diligence. They verify corporate documents, title documents, government approval, SEBI ROC compliance history, litigations, related party transactions, financial statement accuracy, etc. And they issue a due diligence certificate confirming that the offer document is complete and accurate. Once this is done, the DRHP is prepared in accordance with Schedule 4 of the ICDR regulation and filed with SEBI. For standard FPOs, and in case of fast track routes, it is directly filed with ROC and stock exchanges. Simultaneously, the issuer makes a public announcement and the DRHP is hosted on SEBI's website and the website of issuer, lead managers, and stock exchanges. Once the DRHP is filed with SEBI for observations, SEBI reviews the DRHP and issues observations within 30 days. The observations may require amendments to disclosures, additional information, or any kind of clarifications. After so the company must incorporate these things into its DRHP and file RHP with SEBI and ROC. Now, apart from the lead managers, the BRLMs, a lot of other the intermediaries are also appointed pre-issue, which is your registrar, your syndicate members, compliance officers, bankers, depositories, etc. Then, before the opening of the issue, the issuer must publish a statutory pre-issue advertisement in at least one English national daily, one Hindi national daily, and one regional daily newspaper in the language of the state where the registered office is located. The advertisement must state the name of the issuer, issue size, price band, issue period, key risk factors, etc. Then there is the opening of the issue, where the issue must be open for subscription for minimum 3 days for book build FPO or one working day for fast track book build FPO. The maximum issue period is 10 working days. During this period, bids are received through syndicate members, SCSBs, and stock exchange bidding platforms are used using ASBA, which is your application supported by blocked amount facility mechanism. Since all public issues mandatorily use ASBA, investors must apply through ASBAs, and the investor applies through a self-certified syndicate bank SCSB, where the investor holds its savings account and the application amount is blocked. Funds are debited only on allotment, and in case of non-allotment or partial allotment, blocked amount is released without delay. Then now UPI for retail investors also allowed for retail individual investors who want to apply through apps, brokers using UPI ID. Then closure of the issue and final pricing or the cutoff pricing. In book build FPO, after the issue closes, the registrar compiles all bids received, and the cutoff price is determined based on demand. It is a price at which maximum amount of oversubscription is achieved, or the price that results in full subscription of the issue, whichever this is at the discretion of the BRLMs. Retail individual investors can only bid at cutoff price. Without specifying a price, they are deemed to have bid at whatever the final cutoff price is. Coming to the post-issue phase, once the basis for allotment is determined by registrar in consultation with the designated stock exchange, in cases of oversubscription in QIB category, allotment is proportionate to the number of shares bid. In case of oversubscription in RI category, retail individual investors, allotment is done by lottery, ensuring each retail applicant receives at least minimum one bid lot.
There is one
And if
question has been
total,
actually, there is one question has been actually put up. Somebody has actually put up the question, what is SCSB? SCSB is nothing but, as you rightly said, it's a self-certified syndicate bank. What they do is they provide the ASBA facility to the investors. Money is actually not required to be sold out immediately when you make application. You only block the amount. That is the facility which is provided by this. That is the answer for that. There is another question is there, are there any relaxation in procedure in case of the FPO by SME listed company? I think that is not the discussion today because we are discussing on the main board today. The SME, we are going to take it separate series. We will be discussing the related details there. Yeah.
right.
Any time
Then
any time limit to give an advertisement when it has to be issued in newspaper? I think you address the newspaper advertisement, pre-advertisement. I think with reference to that, he is asking the question. Kinjal, you are mute.
sorry, can you repeat the question?
Any time limit to give advertisement when it has to be issued in newspaper?
as per, one second, I had mentioned that.
Yeah, you can go back to the slide if you want. Yeah.
This is advertisement is given before opening of the issue.
Okay. That is what he is
And
asking.
then-
Any time limit is prescribed or something like that.
No, but usually it's 1 week before the issue opens.
Okay, okay. Yeah, just go ahead. Somebody says it is 10 days. Anand Kumar is saying it is 10 days actually. I don't know.
Okay.
Because I think regulation is only before opening the issue. That is what I think, if I'm not mistaken. Brijesh, any idea? The pre-opening advertisement, any time limit is there?
Yeah, see, generally it should be minimum 3 working days.
Okay.
Yeah. So advertisement is in Hindi, English, and regional newspaper.
So that means suppose we are in Bombay,
Yeah.
then we have to give English and Marathi or English or Gujarati.
So generally we prefer business standard Hindi, business standard English, and Mumbai Sakad, Mumbai Chofer. If you are in Gujarat, then it should be in Dainik Bhaskar, of course, whatever the cheapest, being regional. Rajasthan Patrika we take.
No. Because the whole idea is the regulation says one of the largest circulating newspaper in the regional language where the register office is situated.
Yeah.
So
So
the
see,
question will be, if I am in Bombay, can I have an option to select Marathi or can I have the option to select Gujarati?
no, sir. State-wise. So if you are into, say, Hyderabad, there may be Telugu. Maybe in Kerala, then Malayalam. In Mumbai, see, Hindi and English are compulsory. Then in Mumbai, you have to give in Marathi newspaper.
Okay, so I have because although the largest people will be there in Gujarati magazine will be circulating.
No, sir.
Lastly,
It's not
I
about.
cannot choose Gujarati.
No, it's not about community. It's about state-wise.
Okay. Because I am purely looking from the investor point of view. Because most of the people who are actually the business are the people who are actually knowing the Gujarati language, which is one of the Gujarati newspaper which is largest circulating. From that perspective, I was asking these questions.
No, sir. So Hindi, English, both are compulsory and region-wise.
Okay. So that means if you are in Bombay, you have to select Maharashtra, Marathi.
Marathi newspaper.
Okay.
And generally, it's before IPO, it's 3 working days prior to IPO.
Because I see a lot of people, they actually publish in Gujarat Samachar also. In addition to that,
No.
of course.
Yeah. Because that is for your marketing, IPO marketing. Because Gujarat Samachar is a widely circulated, so that is for your extra marketing. But otherwise, Gujarat, giving Times of India, Gujarat Samachar, the Dainik Bhaskar, Economic Times, so these are very costly.
Okay.
Yeah, so generally as a Hindi and regional, we prefer Financial Express with some Dainik Bhaskar combination. And in business standard, we have business standard Hindi and English.
Gentleman is also asking post-issue advertisement.
Yeah, same. So see, generally when you initially, whatever combination you have selected, then similarly you have to follow that. Then you cannot deviate.
Yeah, post-issue advertisement also, any time limit is there?
Sir, it's now allotment is in T+3.
So that means you have to put it in 2 days time.
No. Yeah. So ultimately everything, allotment and everything, now we are doing in T+3. Earlier it was T+6.
I think regulation 26 talks about T+2 only, I think. Normally we see Yeah.
T+3 is a listing and allotment in T+2.
Normally, practically seeing, many people, they issue the advertisement the very next day itself. That is what it is seen practically. Yeah.
Regulation 26 required to make advertisement within 2 days of filing draft offer document. See, that is what I think so Geeta ji is telling, that see, now there are different types of advertisement. So when you are filing first draft document, then it's now mandatory to give advertisement that you are filing of this advertisement. And what we are discussing, IPO opening advertisement, that is 3 days prior. This Geeta ji is telling about so whenever you are filing draft offer document, you have to file this advertisement same in Hindi, English and regional within 2 days.
So that means when you are filing the draft advertisement, it is within 2 days you have to file. If you are actually giving a pre-advertisement, it is actually 3 days advance, at least minimum. It can be earlier. And the post-issue advertisement will be, I think, within 3 days.
Yeah, so that is the basis of allotment which you need to give. Yeah.
Okay, I think clear. Yeah. Yes, Kinjal, go ahead.
Right. So, under the FPO process, minimum subscription of 90% is required. Otherwise, the issue fails and a full refund is required to be made. The basis for allotment is determined by registrar in consultation with designated stock exchanges. Like I mentioned, different categories have different allotments. Usually done on a proportionate basis, or in case of oversubscription, lottery basis. Then, within 3 working days of issue of closure, the registrar completes the basis of allotment and forwards instruction to depositories for credit of shares. Allotted shares are credited to investors' demat accounts, and company completes the statutory listing formalities with BSE and NSE stock exchanges. And trading commences on the listing date. Then, utilization of issue proceeds. The issuer must monitor and disclose utilization of issue proceeds on quarterly basis to the audit committee and stock exchanges until 95% of the proceeds are utilized. Monitoring agency, which is usually a SEBI registered Cat 1 merchant banker, public financial institution, it must be appointed if the issue size exceeds 100 crores for monitoring utilization of such proceeds raised. Any deviation in utilization of funds from stated objects must be disclosed immediately to stock exchanges and requires shareholder approval by way of a special resolution through postal ballot. The issuer must publish post-issue advertisement within 10 working days of allotment refund. The fund utilization monitoring obligation is continuous. It does not end at listing. And in the past, companies have been penalized by SEBI for failure to submit quarterly utilization reports. Any kind of deviation from stated objectives is particularly sensitive. Any material deviation, even given good business reason, must go through special resolution, signaling to the market and regulators. And this is one of the key obligations of audit committees also. Coming to roles of professionals in the FPO process. Company secretaries are one of the important professionals in the process, FPO compliance machinery essentially. You have the draft resolution, shareholder resolution requirements, coordination with SEBI, ROC filings, monitoring timelines. They also verify eligibility conditions, and they also look into the scores, complaints data when it comes to how efficient the company is in resolving investor complaints. It also ensures that promoter holdings are in demat form. In case it also checks the compliance requirements in case of various different mechanisms available under FPO, such as OFS. Um, they also manage trading windows. Um, they look into publishing public announcements when it comes to DRHP filing, monitoring compliance with the issue period, ASBA requirements, ensure material developments that trigger LODR intimation and disclosures are made in time. Um, in the relevant form filings as required. They ensure lock-in requirements are met with. They are the ones that are filing updated shareholding patterns, um, looking into trading window requirements, and secretarial compliance report when it comes to FPO related compliances. They also look into the quarterly fund utilization reports given to the audit committee and stock exchanges. They essentially ensure that the process is undertaken under the guardrails of compliance under Companies Act and SEBI regulations, and it's done smoothly. Now, chartered accountants also and auditors under this process, they are the ones preparing the restated financial statements, issuing audit reports, ensuring internal financial controls, certifying working capital needs, assessing impact of qualifications, many times acting as monitoring agencies, and they also look into pro forma financials for material acquisitions, divestitures, post the audit date. The legal counsel also are the ones who are drafting the DRHP, advising on the structure of the FPO, when it comes to legal tax regulatory standpoint, conducting legal due diligence on contracts, titles, approvals, IPs, drafting the offer document, underwriting agreement, escrow agreements, all the various different agreements with intermediaries as required. They represent issuer before SEBI in response to observations and clarifications that are issued by SEBI. Any kind of FEMA, FDI compliances for foreign investor participation is done. Litigation risk materiality is managed by them. Then directors also play an important role in this particular process. They have personal liability while raising funds in case of any misstatements, errors, omissions, etc. This can be criminal, civil also. Independent directors are required to scrutinize objects of the issue, means for finance through audit committee. Audit committee also plays a very important role in terms of this whole process when looking into and monitoring the fund utilization and deviations from there. All directors are designated persons under the SEBI PIT regulations, prevention of insider trading regulations, where they come under trading window restrictions throughout the FPO process. Um, and so, yes, so these are the various different players apart from the intermediaries that look into this FPO process very closely. Now, SEBI, as we know, regulates this entire process, and the regime under which it operates is quite stringent. So, the penalty regime under SEBI is severe, and directors must understand that their personal liability um, is also underlined. A company that files an accurate prospectus, but whose director had undisclosed conflicts of interest can trigger both civil and criminal action. And the settlement is available, but it has its own consequences for future FPO eligibility. in case of any kind of mishaps that does take place. Now, SEBI has broad enforcement powers under SEBI Act and ICDR regulations. SEBI can issue directions to any persons found to have violated the regulations. Directions may include debarment from capital markets, impounding of proceeds, refund to investors, and disgorgement of unlawful gains, where SEBI can ask the offender to pay 3x of what they have misappropriated or earned through any kind of fraud that has taken place. Now, under Section 15, penalties for various violations are prescribed in Chapter 6A of the SEBI Act. For failure to comply with ICDR regulation, the penalty can be up to 25 crores or 3 times of amount involved, whichever is higher. For insider trading connected with public issue, penalty can be up to 25 crores or 3 times of profit made. There's criminal prosecution also under Section 24, where willful violation of SEBI Act regulation can result in imprisonment up to 10 years and a fine up to 25 crores. SEBI, as we know, is responsible for investor protection mechanisms. So, SEBI complaints are addressed under the score system, where investors can file complaints against issuers regarding non-receipt of allotment letters, refunds, share certificates. High scores complaint ratios affect issuers' eligibility for FPO and a fast track FPOs. The issuer is required to have a designated compliance officer specifically responsible for investor grievance and redressal during the FPO process. ASBA protection is also provided for investor protection to ensure investor funds are blocked and not debited until allotment. Minimum subscription requirements ensure companies adequately funded to execute its disclosed objectives. Utilization monitoring as another monitoring mechanism through which it ensures investor protection and ensures deviations are disclosed as and when that happens.
Krishnan is actually asking, any specific fines or penalties on company secretary and chartered accountant and auditors by SEBI? Because he's saying there is, Rajesh is actually asking no evidence of pending CS auditor and lawyer.
So, sir, generally, merchant banker is the only responsible entity being regulated under SEBI. So, only merchant bankers are responsible. Second, very important intermediary is lawyer. So, even legal and statutory auditors and CS, they are not penalized. Till now, we have not found any of such evidence.
You're right, actually. I also do not know about 2013 Act, but I remember way back in 1956 Act. I don't remember the exact case. There was one case where the misstatement in the prospectus was there, actually. So along with the director, company secretary was taken for the task. A high amount of the penalty was levied on the company secretary. The matter went to SAT. And ultimately, they said company secretary is only ensuring whatever is actually vetted by the directors, in which case company secretary is not responsible for the misstatement in the prospectus, because he is only certifying the things which is basically a directors. That is what I think. It is a way back, a very old case, I think so.
Yes.
Yes, I actually wanted to know one thing from you now, because we have talked a lot of things about investor protection by SEBI. Kinjal also pointed out the main thing on the SEBI Act is actually investor protection. You remember I was talking this Adani Enterprises, FPO, which actually was there in the focus after the COVID.
1 second, sir. Sir, please come again, sir. Sorry, I missed the question.
Yeah, we are talking about the investor protection by the SEBI. That is the main focus, actually, because larger publics are involved in the public entities. So investor protection is the most. This Adani Enterprises, who came out with the FPO after the COVID situation, I think in 2025 or something, they raised about 20,000 crores. In fact, if I remember correctly, that the entire money has been actually fully subscribed actually.
Yeah.
And after that, what has happened is there was a statement from Gautam Adani saying that we are cancelling it. He also used the word protection of investor protection, because I think the price band, whatever they have given, this actually fall below what they have announced for the subscription. That is what it appears to be. So he actually said, in the interest of the investor protection, it is morally, not correct to proceed with the, offer. And as such, to protect the losses of the investor, we are cancelling this. That is what really the newspaper item has come. But if I'm not mistaken, whatever we have seen subsequently, I think basically this all evaluated from that great report which has been published by the Hindenburg, I think so. That was the thing.
Yeah. So,
Yeah,
sir, see, the most important part in FPO,
yeah,
unless otherwise your company is very strong.
yeah.
When you come for the FPO, so what people are doing as a arbitrage, they are selling in the market, and FPO is generally at discount. So they try to subscribe in FPO. So in Adani's case, so see, I cannot discuss in public domain. So that was the different case. That how SEBI actually market price was 2,900 crore in FPO process. Market price corrected to 2,900 and FPO was at 3,100. So somehow they managed through large organization and FPIs through their connects. And ultimately, there may be lots of questions that if it is available at 2,900, then why I should subscribe at 3,100 or some 3,000 rupees plus. I don't know exact price of the FPO. So that is the case. So unless otherwise, as we have discussed, that FPOs are very rare, unless otherwise you are very very fundamentally strong, generally that is happening, that your even in rights issue there should be substantial discount. Otherwise people are doing arbitrage. They are selling in the market and they are subscribing in rights issue or FPO. So Adani, of course, when they plan, Hindenburg report came, stock corrected, somehow being Adani Group very well respected, they got one-time subscription and they have to refund.
Yeah, that is right. As you rightly said, yes, Adani has given us some price band that time. I exactly don't remember. It was well above 3,000, I think so. They gave that, but the stock prices fell down actually when before the day.
So Gautam Bhai is thorough gentleman. So as a best corporate governance, so he has refunded the entire money.
Okay, I will not say anything on that, but the thing is, there are a lot of things which is seen in the newspaper. Basically, manipulation of the market, etc., and all things for the Hindenburg report, etc., and other thing and all, which was actually there. But ultimately, I think they found there was no basis on those things. That was his final verdict. As
So
actually,
sir, see, so as a matter of the lots of rumors and speculations, he adopted the best corporate governance practice.
Yeah, FPO was cancelled. That I know.
Yeah,
FPO
so
was
that is the
cancelled. Money
best
was
thing.
money was refunded. Yeah,
That's the best decision he has.
But one thing is, there all said and done, there are a lot of role to play for our professional, let it be the company secretary, let it be the chartered accountant, by looking at the regulation, etc. Although this is not the very popular method, although it was popular only with the public sector under the enterprises in the past, and also continue to be there, because since the government is the major stakeholder, if they want to disinvestment, that will happen actually, because nowadays it is a partnership between the government and the private enterprises which are actually happening. So in such a case, it will be there, but our professionals have to do a lot of job in relation to compliance, looking into the things and the strategic decision, etc., and other things and all, if we want to be successful of these issues. Yeah.
Yeah, so see, sir, I don't know now our regulatory part has been discussed fully or fully covered every aspect or not. So just to conclude, there, sir, we are, being among top company secretaries and advisors in financial market. There are approximately 50 lakhs to 1 CR. I don't know exact, nearby 2 crore GST registration. So even if we take at least 25 to 30 lakhs of good organization, and we have only 7,500 or maybe 8,000, including SME. So, sir, there is huge scope of fundraising. And ultimately, apart from the traditional practice, this is far, far rewarding. You feel so much doing value addition. So, even if your company, whoever here are members of this discussion, even if sometime your fundraising is not necessary, but when your segment multiple is good, market is good, you should raise some money for some acquisition. You have to grow vertically, horizontally. Global acquisitions are available so much cheap. Now we approach to Europe. There are many companies, very good fundamental companies are available 7, 8 times because of succession issue.
Somebody's asking, can we have the example of calculation of the issue price?
No, see, that's purely on the basis of FPO. It's purely on the basis of that is the management decision. Logically, it should be with some discount, at least
Correct.
5%, 7%. Yeah.
Yeah, correct. The existing market is available. When you are actually going for the FPO, normally it is a discounted price. That is again totally at the distance of the board wisdom. Yeah.
And see, sir, see, logically, well, I was on discussion part on the Adani side. Of course, I was not a banker, but very closely associated with their banker. So, sir, see, logically, now this is purely FPO session. So when they decided for the FPO, sir, very, very surprising that their market price was around 3,500 to 3,600. And and that stock was in FNO, future and option. They decided to give some discount. So, sir, logically, there are many short sellers who have sold in the market and they do arbitrage. So, sir, stock price in by that time it corrected so much, followed by that report. So, stock price went below FPO price. So, when you are into FNO, that is the very, very bad idea. Unless otherwise your company is very, very strong, you should do FPO pricing very, very close to the current market price. And you should be backed by at least 50% institution investor. Otherwise, sir, see, retail, HNI, they do lots of arbitrage. They buy and sell immediately. And in all this recent IPO, why these IPOs are opening at discount? Because you need to have that follow-up buying on the listing day.
We will just quickly do a comparison in terms of avenues available to the company management for raising funds once the company is listed, and just do a strategic kind of evaluation. So we'll just be comparing FPO, rights issue, QIP, preferential allotment. These are the various avenues available to the company for raising of funds once they've been issued, once they've been listed. So coming to FPO, the target investors are all public QIBs, non-institutional investors, retail, employees, etc. Rights issue, they are existing shareholders only. They are raising funds from the existing shareholders only. Whereas in QIP, the funds are raised only from institutional buyers only, and not retail public. Whereas in preferential allotment, you have only selected identified persons from whom the funds are being raised. So under FPO, SEBI review is done for the standard route and not the fast track route. For rights issue, SEBI review is done through standard route and not for fast track rights. QIP, there's no SEBI review, and preferential allotment also, there is no SEBI review. FPO takes 4 to 6 months in standard route, 2 to 4 weeks for fast track. Rights issue, 2 to 4 months for standard and 7 to 10 days for fast track. QIP is the fastest, which allows the company to raise funds within a week. Preferential allotment takes around 2 to 4 weeks. FPO involves retail participation. Rights issue involves retail participation, since the existing shareholders will have retail participation. QIP does not involve retail participation. Preferential allotment also does not involve retail participation. Pricing for FPO is done on market basis and demand basis, and it's usually at a discount of the current market price. Rights issue is discounted to current market price, whereas QIP and preferential allotment has a particular way in which pricing is determined. There is in FPO, there is dilution risk in case of a fresh issue, not so much under OFS. Rights issue, there is minimal if existing shareholders are subscribing. QIP, there is dilution risk. Preferential, there will be dilution. FPO, what it will be best in case for government divestment, recapitalization, increasing public float, etc. Whereas rights issue would be uh, appropriate in case where the company wants to reward existing shareholders and does not want to raise substantial amount of money. QIP involves quick institutional capital raise, and preferential allotment is usually done for strategic investors for certain strategic actions that the company is looking to take. Now, like we have, I think, mentioned multiple times that FPOs aren't the most preferred equity route in India today. So let's just go through why this is so. FPOs, now they are the least preferred today, despite being conceptually straightforward. But in practice, Indian companies just overwhelmingly prefer your QIPs, preferential allotment, rights issue, convertibles, private equity placements over FPOs. Now, this is a combination of regulatory friction, execution risk, market structure, investor behavior, pricing constraints, etc. We'll just go through it quickly. So now, the single biggest reason is the rise of QIP in the market. QIPs have allowed companies to raise institutional capitals in 4-5 days with limited documentation, without SEBI pre-issue observation, lower cost, much lower execution uncertainty. Whereas when you compare that to FPO, it's almost like a mini IPO, where it requires extensive drafting, diligence, regulatory coordination, and may take even months. And it kind of exposes the company to market volatility also during this process. So, hence, you see why QIPs have been preferred over a period of time compared to FPOs. Like I mentioned, FPOs also have high execution risk. Now, for an IPO, if a company is going for an IPO, it usually benefits from growth narrative, novelty premium, retail enthusiasm, media attention, and all. But an FPO, it gets none of these things. Investors already know the company, its quarterly results, management quality, governance history, market valuation. So investor kind of asks, why is this company suddenly raising equity now in this manner? And as a result, FPOs frequently face weak subscription, aggressive price discovery pressure, heavy discount demands. And so this kind of makes it little less attractive when it comes to other methods. Now, in an IPO, investors apply because uh, allotment and listing gains are expected. In an FPO, the shares are already trading daily on the exchange, um, where investors might just ask why, apply through this, why not just buy shares through the market, unless it is meaningfully discounted, and it is attached to a compelling turnaround growth story, which would attract retail participation. But in an FPO case such as Vodafone Idea FPO in 2024, where there was speculative sentiment, liquidity expectations, and things. So historically, FPOs have struggled when it comes to this demand issue under the FPO route. Now, FPOs are relatively expensive and operationally burdensome. It requires merchant bankers, legal counsels, registrars, auditors, extensive due diligence, stock exchange approval, SEBI compliances, marketing, roadshows, offer document drafting. So this kind of, like I mentioned, resembles kind of an IPO process itself. But you compare that to going for a QIP, where the cost differential is massive. And QIPs are cheaper, simpler, faster, procedurally less cumbersome, etc. Now, also FPO is public market fundraising, which means there is broader scrutiny, uncertain book building, retail participation, volatile demand, potential unsubscription, price discovery risk, etc., which kind of exposes the company to all of these different risks. Whereas, by contrast, if you're looking at, say, a QIP, it allows targeted allocation, institutional investors, preferential allotments also allow strategic placements, rights issue preserve promoter control. So that's why, where Indian promoters of companies that prefer certainty of capital, friendly institutional investors, predictable execution, makes this kind of issue difficult for promoters of companies in India. Now, many Indian promoter groups are, highly ownership conscious. FPO increases public float, dilutes promoter concentration, increases institutional scrutiny, potentially weakens control. Whereas in comparison, you have preferential allotment and right issue, which are much better tools for managing promoter economics and control dynamics while raising funds. Now, historically, rights issue was cumbersome, but after ASBA, dematerialization, online renunciation, electronic trading, um, it became far more efficient. So rights issue now offer several advantages, like existing shareholders are rewarded, promoter holding can be maintained, underwriting risk is lower, pricing can be more attractive, regulatory timelines are manageable. So things like this, have over the period of time made rights issue more attractive, instead of an FPO. Indian markets also dominated institutionally in the secondary markets. So India's secondary fundraising ecosystem today is dominated by mutual funds, sovereign funds, pension fund, insurers, alternative investment funds, etc. And these investors prefer negotiated institutional deals, rather than like a public offer. So QIPs suit them perfectly because allocations are concentrated, execution is quick, liquidity is immediate. And so that's why, it makes FPO less attractive. FPO may remain in preparation for months. And during that period, markets can correct, sector sentiments can change, quarterly earnings may disappoint, geopolitical events may occur. Now, this can be devastating for pricing, and investors want to avoid this problem, especially QIPs, because they invest heavily and they come in heavily, and these kind of impacts hit them significantly. Also, SEBI's regulatory evolution favored faster institutional capital formation. So it favors rapid capital raising, institutional participation, electronic execution, low friction essentially. So that's why the ecosystem shifted more towards QIPs, block deals, institutional placements, rights issues. And so it was kind of, QIPs became locked in this awkward middle ground where it's too cumbersome, versus QIPs, too public versus preferential issues, too uncertain versus rights issues, etc., etc. So this, even though this is conceptually, it looks very straightforward, but companies have over a period of time, gone less and less through this route for its fundraising requirements. But having said all of these things, there are a lot of scenarios in which FPOs may be the right choice for the company to raise funds. Now, even though despite their declining popularity, they can be extremely effective in certain strategic, regulatory, and market situations. If I mean, in fact, if it's used in the right context, then it can achieve objectives that a QIP rights issue or preferential issue cannot achieve as effectively. So the FPO is not merely a fundraising tool; it is also market positioning, ownership reshaping, liquidity expanding, and legitimacy enhancing instrument. That's why a lot of companies in the past have deliberately chose FPO when faster fundraising alternatives are available. Now, this could be the case when the company wants a broad-based public participation. Now, this is a strongest strategic case for choosing an FPO. So, unlike a QIP, retail investors can participate, HNIs can participate, institutions can participate, foreign portfolio investors can participate. This creates a wider ownership distribution, greater market visibility, and enhanced liquidity, and stronger retail shareholder engagement, essentially. Now, this is usually useful when the company wants to deepen its investor base, increase retail ownership, and improve marketability of its stock. Now, the other cases where this may be um, uh, advantages is when the objective is to increase market public float. This is again, like I've mentioned, used extensively by uh, uh, public companies, PSUs, where they have used FPOs to divest their investments over a period of time. So it kind of allows the company to increase its public float in a structured and transparent manner. Now, this route can be also used when the company requires very large capital raising. So for exceptionally large capital raises, it may be superior to QIP. Now, QIPs are practically constrained by institutional appetite, pricing sensitivity, concentration limits, absorption capacities of institutions. So, if a very large amount of capital is to be raised, an FPO could be useful because it allows retail tapping the retail capital, HNI capital, institutional capital, etc.
Angel, we are
Now,
on 115. We are at 115. You have to wind up.
yes. So, under this, Yes Bank was a classic example where it needed to raise large scale recapitalization, and increase public participation, create confidence in the public, and improve market credibility. Now, FPOs can also be very important when the markets are extremely bullish. When there is euphoric liquidity cycles, retail participation booms, there's strong secondary market momentum, high risk appetite periods. So, in such environments, companies can raise capital at attractive valuations and retail participation becomes aggressive. So this period can also be, a time when companies can consider FPOs. Now, like I mentioned, they are also used when companies want stronger market legitimacy. It's when it's a public market validation event. It is essential when companies emerging from stress, such as Yes Bank, governance concern previously existed, balance sheet was weak, institutional trust must be rebuilt. So a successful FPO essentially signals market confidence, investor willingness, pricing support, liquidity depth, etc. So it can essentially help to fix the reputation of the company over a period of time. Um, Now, there may be times when retail inclusion is politically or strategically important, particularly relevant in India, where retail ownership creates political legitimacy, wider participation aligns with policy objectives. Government may want citizen participation in strategic assets. This is true for PSUs, infrastructure financing, telecom, utility fundraising. strategic national divestment programs, etc. Again, when there is high capital raises, institutions may not be able to absorb the entire issue. So that's when FPOs and retail tapping of other types of investors also can be done through the FPO. FPO also, allows transparent price discovery. As against QIP's preferential allotment, where it is negotiated, and so FPOs are more market driven. Coming to when promoters want partial dilution without losing control, to increase public float, reduce uh, increase public participation, etc. For compliance reasons, they can go for FPOs, as companies have done in the past. Stocks with low float, concentrated holdings, weak trading volumes, they suffer from valuation discounts, higher volatility. So they are not able to negotiate good value for their shares with institutional investors, is when they can probably go out in the market and consider FPO as an alternative route. When companies also want international visibility and institutional investor visibility, FPOs can help them attract sovereign funds, uh, global institutions, pension funds, international asset managers, and it's helping companies make FPO a global investor outreach exercise, liquidity enhancement event, institutionalization milestone, etc. Now, if the existing shareholder capacity is
Kinjal,
low, then the right
I think, Kinjal, I think we have to speed up. It's 1:10.
Yeah, I already said actually
many-
1:15.
yeah.
So what's how many slides left?
This is the last one.
Okay, just wrap up in.
Now, when current shareholders may not be able to absorb the issue, then they may go for FPOs. You have if there is a successful IPO, then it may help the company strengthen its improve its governance perception, analyst coverage, institutional participation, market confidence, and this can contribute towards valuation re-rating, and things like that. So essentially, kind of build up the reputation of the company. So anyway, having said that, looking at the pros and cons of FPOs, I think we can take this session to an end, and we can see if we have any question answers.
I think there is only one question is there actually. Can you briefly explain the calculation of QIP and preferential allotment pricing point?
So we will be taking that up in our QIP session.
Then that's all. Then I have done with all the questions. There's no other question because all the question has been already answered actually. One more question has come actually. Can an existing shareholder participate in FPO? Yeah, it is actually existing shareholders only actually. That is one thing. I think Raj Garg has risen his hands actually. Raj Garg, you are still there. If you are there, you can speak, you can unmute, you can speak actually. He's the only hand which is risen I have seen. Raj Garg, are you there? Raj Garg?
No. Mr. Bala, I think by mistake he has done.
Okay. Then that is all I think. So now it is almost about 1:20. I was also thinking such a small topic, not very popular topic. There would be much of the participant. All the things I said, you also had expressed your concern. But we saw as many as 132 people now at the closer of our also. We have 82, even at 120 when we are all hungry. But still, people are hungry for knowledge. That is what it shows actually, really speaking. In fact, there are a lot of appreciation has actually also come for Kinjal. Excellent and exhaustive presentation, good learning and well spent on Saturday. All the things which are actually coming, I can really see that. Really, really credit goes to Kinjal for your well preparation and, good articulated sessions with the relevant things. That's what I could say. Especially, I like your comparative statements. Whatever you have brought out the issues, that is one thing. You can have a good lunch.
Thanks, everyone. I think we can close it. Thanks a lot. Thank you, our panelist, for his insightful knowledge sharing, practical experience sharing. And of course, he has given us idea about fundraising, during the technical hitch we had today. We all are, Meta and Meta, extremely feeling sorry for the same. Thanks for your time. Thanks, everyone. Thank you.
Thank you. Thank you. Thank you, everyone. Thank you so much.
Thanks.
Thank you,
Thanks a
Thank you,
lot.
Brijesh.
Bye.
Thanks a
Thank you,
lot,
Mr.
Brijesh.
Brijesh.
Arey,
Thanks a
sir,
lot,
my pleasure. My pleasure, sir. For any of your next presentation, sir, keen to be panelist, sir.
Thank
Oh,
you. Thanks a
we are,
lot.
we are greatly honored. Thank you. Thanks a lot.
Thank you so much. Thank you, participants. Thank you. Bye.
Thank you.
you.
Thank you, everyone.
Okay, thank you to everybody. With this, we close our sessions. We will yet meet in the next session, the next Saturday. Thanks a lot. Thank you.
Thank you.